Hey, this is Chris, and in this video I'm going to be sharing my 4 tips for investing when you're retired. And my first tip is really understanding that when you're retired, you're actually balancing a few different things when it comes to investing. I think a lot of retirees are really focused on the risk side of their portfolio and making sure they don't have big drawdowns or you don't lose a lot of money. But actually, when it comes to retirement, you're balancing different risks. There is the risk of losing money in the short term, but you've actually got to balance that against a different type of risk, which is shortfall risk. The risk that you're going to outlive your retirement nest egg, and making sure that you are earning enough of a return to keep up with inflation and ensure that you still have funds to live off in the future. And so my first tip is making sure that you're really striking a balance between that short-term market risk, which is an inevitable, and ultimately, that you can get through that, and you're going to need a little bit of market risk in most cases to be able to continue to counteract the other risk, which is shortfall risk. The risk that if you've got all your money just in term deposits or bank accounts, the cost of living is going to be increasing a lot faster, and it's going to be hard to keep up with that and continue to have a nest egg to live off. So that's my tip number 1. Tip number 2 is making sure that you've got a strategy that aligns 1 with your investment time horizon and 2 with your cash flow needs. So time horizon is the easy one. If you've got a time horizon of 5 or 10 or 15 years, you can still afford to have some growth assets in your portfolio. It doesn't make sense for most people to have everything in defensive assets only, because that's enough time to recover if markets are volatile in the short term. But also you've got to balance this around the income needs you have along the way. So if you're in the drawdown stage of your retirement and you need to live off, let's say, 5% of your portfolio per year, that's very different to someone that needs to live off 10 or 15% of their portfolio per year, because if you're only drawing down a small percentage, it doesn't really matter if markets are up or down in that year. And I would say it's pretty similar to dollar cost averaging when you're investing, is actually when you're drawing down from your portfolio, you're dollar cost averaging out. And so you shouldn't really be worried about markets going up or down year to year if you're just taking out 5% per year. Some years you're going to get lucky and sell high. Some years you're going to get unlucky and sell a little bit low, but they'll all balance out over the long run. But really, if you're only drawing down a small amount, you can still afford to have some growth assets in there as well. And I think it's a common misunderstanding that if you're drawing down from a super asset, that you should only have defensive assets at that point. It's also sometimes a belief that you need complete assurity around the future, and buying an annuity is the right way to go. And I would say if you're considering that as an option, you also need to think about the risks of annuities and the costs of annuities. So the risk of annuity is the shortfall risk often, and the cost is that there are often huge fees built into annuities in order to guarantee that future. And really the cost that you pay there may not outweigh those benefits. And from my appreciation and understanding, I really think in most cases, getting the right asset allocation between growth and defensive assets makes more sense than annuities, just because the cost of annuities is so damn high. And so the margin is all going to the annuity industry and to the advisors and to the people that are selling them, rather than staying in your balance. So they give this false idea of you're guaranteeing your future, but in most cases you're going to be guaranteeing a worse future than you would have had you not bought it. So that takes me to the third tip I have, which is if you are managing a portfolio, make sure it's diversified across all sorts of different assets and all sorts of different sectors, and that you're not too concentrated in certain stocks or sectors of the market. I think this is a really pertinent one for a lot of Australian retirees that have a lot of banking stocks in their portfolio because they were lucky enough to buy them, when CBA listed in 1991, or when Telstra, demutualized. So they're very concentrated in, let's say, banks and telcos. You want to make sure that you also have some global stocks in there, but also defensive assets like bonds and gold that will perform well in different market environments. So if we go through some tough economic times, it may be that bonds do well. Or if we go through a period of high inflation, it may be the gold that actually saves your portfolio. Having all of these different pieces in your portfolio will help to provide a more smooth path and actually give you more confidence that you'll be able to reach your retirement goals and be able to draw down for as long as you need. And the last tip then I would have is about setting a process for rebalancing. So we know when it comes to investing, rebalancing is a critical part of keeping your portfolio risk in check over time. And a common mistake I see with retirees is that they just let their portfolio go, and it may be one share within the portfolio or one asset class or one market becomes very big relative to everything else. And you won't really notice it when markets are going well, but when a crisis hits, you'll suddenly see that part shrink very fast and you'll lose a lot more than you really need to be or should be. So setting a regimented process for rebalancing, and by that I mean selling some of the things that have done well and rebalancing it into asset classes that might have underperformed. It's going to make sure your risk is balanced over time, and so when markets do fall, and at some point they will, that you're not too exposed to a certain sector or a certain share. And that will really give you more confidence to stay invested over that time and not to capitulate and sell everything, which you really probably shouldn't be doing when markets fall, because you should have a strategy that allows for that level of volatility. Now, my tip would be to automate that rebalancing strategy, and the reason for that is I see a lot of retirees that may have a rebalancing strategy that they're planned, but when markets get volatile, they stop following that process because they think they can time the market better and they're waiting for a better time to buy, but then they never get that chance and the market goes back up. 2020 was a good example. We automatically rebalanced for all of our clients, and I could see a lot of resistance when markets had crashed. Not many people wanted to sell bonds which had done very well and gold which had done well and put it into shares after they'd fallen 35%. A lot of people were coming to us saying, but I think it might fall 40% or 50%, but ultimately it doesn't matter. The right time to rebalance is when these assets have moved a certain distance from their target weights within your portfolio, which is exactly what has happened at that point in time. And so it is a good idea, I think, to set a regimented and systematic approach to rebalancing so your emotions don't get in the way of the right decision. And that happens in both directions. When markets fall, people don't want to be buying, and when markets rise, they don't want to be selling because they think they're going to rise and rise and rise. So automate it. It will allow you to sleep better at night. You won't need to worry about it. You'll be able to go off and enjoy the things you want to be doing. And I think it's going to give you a lot more confidence around your investing. And they're my 4 tips for people investing in retirement.